All right, diving in. We're tackling One Up on Wall Street this time.
Oh, Peter Lynch.
You know it. And this one came from you guys. You requested this deep dive, so thanks for sending over that summary.
Yeah,
So, we've got legendary investor Peter Lynch, not just a Wall Street guy,
right.
but someone who thinks that you and I, the average person,
hmm
we have an advantage.
Yeah, he really flips the script on kind of traditional investing.
I love that. Okay, so what's the advantage we've got?
So it really comes down to, his famous quote, right? Invest in what you know.
Ah, yeah.
He doesn't think that your personal experience is just, anecdotal.
Oh,
It's
interesting.
actually insight.
So give me an example. How does this play out in the real world?
So let's say you're a parent and you're at your kid's soccer practice
Okay.
and you see all the other parents wearing this one brand of athletic wear.
Okay.
This company's just popping up everywhere. Their clothes are flying off the shelves.
Yep.
Lynch would say that's information.
So it's like just being aware of what's happening around me.
Yes,
That's
exactly.
already in my life.
You're more likely to see it right before maybe somebody who doesn't have kids, doesn't go to those practices, doesn't see what you see. You understand the appeal.
Right. You get it. You get why people like this.
Exactly. You see the quality, maybe even the potential problems
Uh-huh.
that competitors might miss.
Wow, so this is like insider information,
Yeah.
but it's just like life.
Right.
That's pretty cool.
It's powerful.
Okay, so we're observing the world around us. We're finding these potential companies.
Uh-huh.
But I think Lynch takes it a step further, right? He categorizes them?
Yes, he does. He has 6 types of stocks.
6.
6, yeah. And, we don't have to go full textbook here.
No.
But, he's got the slow growers, the stalwarts, the fast growers, cyclicals, turnarounds, asset plays.
Okay.
But I think for you, based on what we've talked about, the stalwarts might be really interesting.
Stalwarts, what are those again?
So those are the kind of, big established companies.
Okay.
They have a track record of just steady growth
I see.
and profitability.
Yeah.
Really reliable. These are the blue chips, the household names.
Right.
Been around forever.
So probably not going to like double overnight or something crazy.
Yeah, they're not the flashiest.
Right.
But they tend to be a little less volatile than other types,
Gotcha.
and they often pay nice dividends.
Okay, now we're talking. Do you have like any examples of these stalwarts? What kind of companies?
Oh, absolutely.
Right.
So, you think about companies like Coca-Cola,
Okay, yeah.
Procter & Gamble, Johnson & Johnson.
I get it.
Big companies, really strong brands.
They've been around forever.
Yeah, global presence. They always pay those dividends.
Makes sense. Okay, so steady growth, that's one piece.
Mm-hmm.
But Lynch also says something about growth at a reasonable price.
Yes, JARP, growth at a reasonable price.
JARP. I like it.
It's finding that sweet spot
Okay.
between the company's growth potential, but then also what it's valued at right now. You know what? Overpay.
Right. So how do I avoid doing that? I see a company, everyone's excited. How do I not get caught up in the hype and pay too much?
Research. Lynch is all about understanding the fundamentals before you buy anything.
Okay.
You're looking at the financials, their earnings growth, the profit margins.
Oh, I can't just love their product or see that it's popular.
Right.
I've got to look under the hood a little bit.
Exactly. And, what I find so fascinating about Lynch is he believes every good investment has a story.
Oh, tell me more about that.
You got to think of yourself as a detective.
Okay.
You're trying to figure out, is this company truly undervalued?
Uh-huh.
And the clues are in their financials, their history, their vision.
So it's not just looking at numbers, it's understanding the company's story.
Yes, your journey. You're not just buying a stock.
Right.
You're investing in a narrative.
Love that.
And the growth trajectory is a big chapter in that story.
Okay, and this takes us back to that JARP thing, right?
Yeah, growth at a reasonable price. You don't want to overpay,
Right.
even if the company seems like it's going to be the next big thing.
Give me an example. How does this actually happen?
Okay, let's say you hear about this company. Everyone's buzzing. They're disrupting the industry, revenue skyrocketing, analysts are predicting amazing things.
Right.
But then you look at the stock price, and it already reflects all that future potential, maybe even more.
Oh, so what if they don't actually hit those expectations? Or something happens?
Yeah, that's the risk of overpaying.
Right.
The company stumbles, the stock could tank, you could lose a lot.
Oof. So we got to find that balance, the excitement, but the caution.
Right.
You want the growth, but not at any price.
You got it.
So how do we know if the price is reasonable compared to how much it's going to grow?
Well, this is where Lynch really loves the PEG ratio.
A PEG ratio.
Price earnings to growth. It helps you figure out, is this a bargain or is it overpriced?
You know, I've always been a little intimidated by the PEG ratio. Can you break it down for me? Make it easy.
Absolutely.
Yeah.
It takes that familiar PE ratio, that price to earnings ratio,
Yeah.
but then it adds in the earnings growth rate.
Okay.
So it tells you how much you're paying for each unit of expected growth.
Oh, so it's not just what they're earning now.
Right.
It's how fast those earnings are going up in the future.
Exactly.
Okay.
So for example, if a company has a PE ratio of 20 and an earnings growth rate of 10%, their PEG ratio would be 2.
Okay.
And generally, a PEG ratio of 1 is considered to be like fair,
Okay.
meaning the stock price is kind of right there with the growth prospects. Anything below 1 might be undervalued. Above 1, you're probably paying a premium.
So lower is better, basically.
Yeah, you're getting more growth for your buck.
It's like a sale on future earnings.
I like that. I like that a lot.
Right, so PEG ratio, powerful tool. But even if we find a company, great PEG ratio, good story, price seems right. This isn't like get rich quick, right?
No, absolutely not. Lynch is all about patience.
Okay.
He really believes that's a key virtue of an investor.
You know, they say time in the market beats timing the market.
Exactly.
Is that kind of what he's
Yeah,
saying?
trying to time the market, predict when to buy and sell to perfectly maximize your gains.
Right.
It's so hard. Even the pros struggle with it.
Mm-hmm.
It's much more effective to just find the great companies and hold on.
So just let it ride.
Let those earnings grow, share prices grow.
So does that mean we just sit there and do nothing? We buy a stock and we just never look at it again?
Not exactly. Active management is still important.
Okay.
But it's not about frantically trading based on every little market wiggle.
Right.
It's more like you check in on your companies, make sure they're still on track with their growth.
Okay.
Adjust your portfolio as you need to based on your long-term goals.
So I'm envisioning like tending a garden,
Oh, I like that.
not playing poker, you know?
Right.
We select our investments carefully. We nurture them, and we don't yank them out of the ground at the first sign of trouble.
I love that analogy.
And gardens benefit from having different types of plants.
Right.
So I'm guessing portfolios benefit from different types of companies.
You're exactly right. Lynch believes in diversification, spreading your risk
Okay.
across different companies and industries.
Diversification, that makes sense. Don't put all your eggs in one basket, right?
Exactly.
But how do we balance that with, like, staying focused?
Well, you don't want to go too crazy with it,
Okay.
Holding too many stocks, it gets hard to really track each company.
Makes sense.
And it can dilute the impact of your winners.
Oh, interesting.
So it's about finding that sweet spot.
Gotcha.
You're diversified enough to manage that risk,
Yeah.
but not so spread out that you can't really keep up with what's going on.
Okay. All right. So we've covered a lot. Investing in what we know, different types of stocks, looking at the financials, PEG ratio, thinking long term. It's a lot.
Yeah.
But I feel like there's one more piece. Lynch talks about trusting your gut,
Yeah.
but he doesn't just mean blindly following your intuition, does he?
No, he does not.
Oh,
He's not advocating for reckless speculation,
okay.
but he does see the power of intuition, especially with that investing in what you know.
Right.
Who better to understand the potential of a local business
Yeah.
or a product that you use all the time?
Than someone who actually uses it.
Exactly. Someone with that firsthand experience.
So how do we balance that gut feeling with, the need to actually do some research?
Okay, so let's say you have this favorite coffee shop.
Right.
You've been going there for years.
Okay.
You love the coffee. The service is awesome. It's always packed.
Yeah.
You just have this feeling they're onto something.
Got it.
Like they could be the next big chain. Your intuition is telling you that.
Okay, but then I decide to look into it a little bit,
Well.
and it turns out they've got a ton of debt,
Exactly.
or their profit margins are way smaller than I thought.
Yeah. So that's where the research comes in.
Right, right.
Intuition can be a great starting point, a way to generate ideas.
Okay.
But you got to back it up with hard data.
Yeah.
Look at the financials, read the reports, analyze the competition.
So it's the art of noticing.
Yeah.
And the science of analyzing.
I like that.
We can use our personal experiences, see the opportunities. Then we got to put on our detective hats, make sure the story actually checks out.
And that's what's so great about Lynch's approach.
Mm-hmm.
He's not saying you need a fancy degree or connections to be a good investor.
I like that.
It's about combining your knowledge with good research,
Okay.
a long-term view, and a healthy dose of skepticism.
I love that. So it's being curious, being observant, and willing to learn.
Yeah.
It's about taking control and not being
Oh,
scared of the stock market.
you got it.
I like that.
It's not as intimidating as it seems.
No, it's not.
Especially with Lynch's guidance.
All right, so we're wrapping up this first part of our Peter Lynch deep dive, but we'll be back, so stay tuned for part 2. See you then.
Looking forward to it.
Mm.
It's not as simple as just like throwing darts at a board.
Right, right.
You want to make sure you're spreading that risk around.
Okay, I think I get that. So what's next? What else did Lynch have to say?
Well, one of the things that Lynch emphasizes is the idea of thinking like an owner.
Okay. An owner of what? Like the company?
Exactly. When you buy stock in a company,
Yeah.
you're not just buying a piece of paper.
Nice.
You're becoming a part owner of that business.
So I should act like it.
Yeah. You should think like an owner. And what do owners care about?
Well, I guess they care about whether the business is doing well.
Exactly. They want to see the company grow. They want it to be profitable.
Right.
They're invested in its long-term success.
So how do I do that as a, small-time investor?
Well, it starts with really understanding the businesses that you're investing in.
Okay.
Don't just buy a stock because somebody told you it was a hot tip. Do your research. Read their financial statements. Understand their products and services.
So back to that detective work.
Exactly. You want to be able to answer questions like, what are the company's competitive advantages?
Okay.
What are the risks they're facing? What's their plan for the future?
So it's really about being informed and engaged.
Yeah, absolutely. Think like an owner, and you'll be much more likely to make smart investment decisions.
I love that. It really gives you a sense of ownership, like you're part of something bigger.
It's empowering.
Yeah, it is.
It changes your whole perspective on investing.
Absolutely. Okay, so we've talked about understanding the story, doing our research, thinking like an owner. What else should we be thinking about?
Well, Lynch also had some interesting things to say about mistakes that investors often make.
Oh, okay, yeah. Like what?
Well, one of the biggest mistakes is getting too caught up in the short term.
Oh, I think I'm guilty of that sometimes. I get impatient.
It's easy to do, right? You see the market going up or down.
Right.
And you want to react. You want to buy or sell based on those fluctuations.
Yeah.
But Lynch argues that that kind of short-term thinking can actually hurt your returns.
How so?
Well, because you end up buying high and selling low.
Oh, right.
Which is the opposite of what you want to do.
Yeah, that makes sense.
Instead, he advocates for taking a long-term perspective.
Okay.
Focus on finding great companies and holding on to them.
Gotcha.
Even when the market is volatile.
So it's about riding out the waves.
Exactly. Don't panic and sell when things get rough.
Right.
And don't chase the hot stocks that are going up quickly.
So patience and discipline are key.
Absolutely.
Right.
Remember, investing is a marathon, not a sprint.
I like that. But sometimes it's hard to stay disciplined,
Oh, I know. It could be tough.
Especially when you see others making quick profits.
Yeah, but remember, what goes up quickly can also come down quickly.
True.
And it's much better to focus on building wealth steadily over time.
All right, so we've talked about avoiding short-term thinking. What are some other common mistakes that we should watch out for?
Well, another big one is ignoring valuation.
Okay, yeah. That jar thing again.
Exactly. Just because a company is growing fast doesn't mean it's a good investment.
Right.
You need to make sure that the price you're paying is justified by the company's earnings and growth prospects.
So we got to check that PEG ratio.
Right. Don't overpay for growth, no matter how exciting the company seems.
All right, that's good advice. What else did Lynch warn against?
Well, he also cautioned against following the crowd.
Oh, okay.
Don't just buy a stock because everyone else is buying.
Right, that herd mentality.
Exactly. Do your own research and make your own decisions based on your own analysis.
So be independent, be a critical thinker.
Yeah. Don't let the hype sway you.
Gotcha. So we've got a lot to think about here. Thinking like an owner, taking a long-term view, avoiding common mistakes.
It's all part of the process.
And remember, it's a journey, not a destination.
Exactly. And with Lynch's guidance, we can all become smarter investors.
All right, well, that's a great place to wrap up part 2 of our Peter Lynch deep dive. Stay tuned for part 3, where we'll continue exploring his insights.
It's about tuning out that noise and really focusing on what matters.
Yeah, sticking to our plan.
Exactly. So, we've talked about a lot of different principles and strategies, but ultimately, I think one of the most important things that Lynch emphasizes is the idea of taking responsibility for your own investments.
Okay, yeah. What does that mean, practically?
Well, it means doing your research,
Yeah.
making your own decisions,
Right.
not relying on others to tell you what to do.
So not just blindly following a financial advisor or...
Right, exactly. You want to understand the why behind your investments.
Okay.
Why are you buying this stock? What do you believe in about this company?
So it's about being informed and making conscious choices.
Exactly. It's
Yeah.
your money, your future,
Right.
and you should be in the driver's seat.
I love that. It's empowering.
It is.
You're not just handing over your money to someone else and hoping for the best.
You're taking control.
Yeah, and that can be a little intimidating, I think, for some people.
Oh, I know it can be.
But it's also exciting.
Absolutely. It's exciting to be in charge of your own destiny.
Okay, so we've covered a ton of ground here. We talked about investing in what we know, understanding different types of stocks, doing our research, thinking like an owner,
Right.
using tools like the PEG ratio, having a long-term perspective,
Patience is key.
avoiding those common mistakes, tuning out the noise, taking responsibility.
It's a lot, but it's all connected.
It is. And I think it boils down to this. Lynch believes that anyone can be a successful investor.
Absolutely. It's not about being a genius or having insider information.
It's about having the right mindset.
Exactly. It's about being curious, being disciplined, being willing to learn.
It's about taking that first step, getting started.
Yeah. And then keep learning, keep growing, keep refining your approach.
It's a journey.
It is.
And it's a journey that anyone can take.
Anyone.
Well, I think that's a fantastic note to end on. So thank you so much for joining us for this deep dive into Peter Lynch's One Up on Wall Street. I hope you found it as insightful and inspiring as I did.
Me too.
And remember, the journey of investing is just beginning. Now it's your turn to go out there, apply what you've learned, and start building your own financial future.
Happy investing.
Happy investing.